Okay, guys, welcome back. Welcome to the Crypto Report. I hope everybody's doing wonderful today. Absolutely wonderful on this Wednesday. An FOMC meeting live stream for you guys. We've been promising it all week. Here it is. I'm ready to go. Let's get into it. Thank you for choosing the Crypto Report for this very significant day. On this channel, we bring you guys breaking crypto news day in, day out. We are live streaming every FOMC meeting possible. I think I've missed one since we started doing them because sometimes life gets you. But man, I love doing these things, and I love when all you guys are hopping in. So many folks watching on X right now. Welcome to the Crypto Report. This is a YouTube channel, and we've got a YouTube account if you want to check it out, the Crypto Report. On X, if you're watching, go ahead and repost the stream out, because here on this channel, I let you guys listen to the Fed speak himself. I'm going to let you guys hear exactly verbatim what the Fed's saying. We're going to stream that live, and I'm not even going to interrupt at all. And then at the end, I'm going to break it down for you on how I'm reading into it myself personally, noting I'm not a financial advisor. I'm a guy. I've been a guy that's been in crypto since 2016. Me and my partner on this channel, Black Sea, we have been bringing crypto content for years now, over 5,000 crypto videos for you guys out there. And these live streams for these FOMC meetings are definitely the biggest thing that impact the markets every single time. They're big moments. And we officially have the announcement from the Fed of whether or not we are getting this rate cut or not. We should have the announcement. And so I'm going to try to pull this up for you guys and look at the FOMC, see if we've got it. Do we have the official update? Let's pull it up. I don't think we have the official announcement yet. If you guys are catching the official announcement, let me know. It's paused. It's paused. Okay, we're pausing the rates. Marty gave us the first update in the chat. I cannot show you the Bitcoin chart while he speaks. What you should really be doing is pulling up the Bitcoin chart on another screen and listening closely to what the Fed is saying. I like to just zoom in on the Fed and track the price on another screen. And I recommend you guys do that as well, because these are difficult days for trading, okay? They're difficult days for trading. There is tremendous opportunities on a day like this, but there's a huge amount of risks associated with trading on a day like today. So if you are doing some trades, first of all, you can sign up for Blowfin, and you can trade using our link I've got pinned in the comments in the chat for you. But if you're in these trades, you got to be in and out of them, because on days like today, both sides like to get liquidated. Okay, both sides of the trade tend to get liquidated, guys, and you need to be a winner if you're in a trade today. Okay, so if you're in a profitable position, a significantly profitable position, be ready to take those profits on a day like today, because again, it likes to trade on both sides of the coin. Both sides of the coin, pun intended. Pun intended. Okay, so let's go ahead and share the right screen here, the entire screen. Boom. There we go. All right, folks. Right now, you got Bitcoin sitting at, let's refresh it, 96.4, 96.5 now. Let's look at the chart right now as we're kind of buckling up. I've got this ready to go. And so when it's time, in just a few short minutes, coming up in 25 minutes, the Fed will actually be speaking. We've got a little volatility to the downside out of the gates here. I think we've probably just got the official announcement. Marty says that we have a pause officially in the chat. Thank you, Marty. Looking at what we've got going on, we pumped into this morning. Now, I do have the reason, I believe, for why we were pumping in the morning hours, okay? I've been slightly bearish in the short term lately because, frankly, it's not looking good for a rate cut in general. Okay, folks? It's just not looking great for a rate cut in general right now, unfortunately, because of some of the data we've had come out. probably the biggest thing for the day and why we are seeing, and I'm going to jump right into it. Probably the biggest thing for the day that we are seeing. This right here, I've got this right here, guys. Okay, check it out. This is FOMC day. Yes, this was the big story, and I shared it with you in a Crow video earlier. We actually, on the 6th of May, and you can see that right up top here, we had $14.8 billion that the Fed bought treasuries with on the 6th. On the 5th, we saw $20 billion. That is $35 billion buying into treasuries from the Fed over the last 2 days. This is signaling potential quantitative easing. We saw a slight odd increase of a rate cut today because of this news, I believe. That is why the markets came up a little bit today. That is why we saw a slight jump in the odds of a potential rate cut today. And by slight, I mean very slight. There was a very, very low chance that we were going to be getting a rate cut today. And we didn't. So, let's see if we actually have the announcement. FOMC rates decision. Hold steady. Okay. As Trump's tariffs cloud economic growth. There you go. And gosh, we've been talking about the orange man with the red tie, the president, a lot. I mean, we've been talking about him a lot. Unfortunately, and I think people are sick of politics. But unfortunately, we're at a time in history where politics has bled into the crypto markets. And, maybe there is some suppression. In fact, there's definitely price suppression going on right now. You can see that when you're starting to look at some of the options, especially. There's absolutely price suppression going on right now. But the announcement is official, and this is the real thing holding us back, regardless of tariffs, which have certainly not helped the equation regarding inflation and potential for a rate cut. Regardless of that, the Fed came out and they said that they're going to hold the rates steady. That's official. And then, here's your language, haphazard trade war, right? Shouldn't be surprised with that kind of language from this publication, obviously. I think everybody's caught on to the trend now. This is just what you've got going on. But they are just going to wait. Officials have said it's best to wait on the sidelines for data. We're always waiting on data. But they did buy some treasuries. So today, the biggest thing that all 1,400 of you guys watching this thing right now should be waiting for is language. So I'm not going to be personally, I don't like pulling up the Bitcoin chart on the screen because I want you guys to focus on what the Fed is saying. It's a smart day to be trading in a quick way, in a very quick way, if you're a risk taker. If you want to be really smart, you kind of sit on the sidelines and wait to see the trajectory we're going to go after this meeting. So, again, I've been slightly bearish in the short term lately. There is good reason for it. It's because we knew this was coming. We knew we'd get kind of a rate pause today. We've been looking at the odds, but I want to remind you guys of the long term, right? And why it's fine to be sitting on the sidelines and not trading today. It's fine to be trading today. There's great volatility to make some trades if you want to. I got links for Blowfin if you want to do some trading, but be careful. Bull BTC prediction from options market. Right now, some of the options, there's options that are suppressing the market, but there are some options that are actually calling for a 300K Bitcoin by June, which might be a little far-fetched, but Kathy Wood and Robert Kiyosaki predict even higher, targeting $1 million per Bitcoin. I don't think they're calling for that by June. If they are, that's ridiculous. I think Bitcoin can easily go to $1 million at some point, but to expect it to go there, by June is just, it's just wild because we really need, I think, rate cuts in order to kind of get Bitcoin to explode. Now there is a world where Bitcoin is the outlier here. Okay. There is a world where Bitcoin is the outlier in that it rallies while altcoins don't as much, which would make sense for a potential boom in Bitcoin dominance, which we're seeing right now. And I do believe, I've been consistent in believing that, 70 to 73% could be on the table for our Bitcoin dominance metrics, which means, perhaps altcoins slip a little. And we are seeing, after a nice bounce for total market cap, we're seeing things slip as nobody really likes the news of a rate pause. And here you go. You found, and here's your levels for trading, guys. You take the high and boom, there's resistance. In fact, we didn't even get up to the resistance truly at the top here on the hourlies. But if you look at the daily candles, our daily candles got real close. Okay, real close. We came up to the high yesterday. Is kind of where this daily candle opened at, and now here it is a little bit lower. We wicked a little higher. I'm looking maybe at a bounce to 92. It could happen. We could come down to 92 during this meeting. We could shoot up to 100. And I put a question in the polls for you guys. There's a chat poll going on YouTube. Do you think we're going to 90, below 90, I should have said, or to 100 first? Like, which one do you think is going to happen? Like 90K? You think we're actually going to break through 90000 first, or 100,000 first? Even if we just touch it, which one do you guys think? I've got my opinion, but I want to hear what your opinion is. I'm very curious because right now we do have a vote out there. And shout out to Scossum. Appreciate that super chat, my brother, my friend. Thank you very much. We do have a poll right now. 64% of you guys believe that we're going to 100K first. And I got to be honest with you, I'd love that. But part of me says maybe 90 first. That bearish part of me, and I do in quotations because I lean bullish in general for crypto overall. I think we could stop at 92, maybe stop at 92. Maybe we come back down to this other wick we had here. Maybe these other, daily candles that we kind of had closing over here. Maybe we're coming down to, 90. You really want us to stop at 88, because if we don't stop at 88, we bleed further and we come back down, which we're going to keep it on the table. Okay. We're going to keep it on the table, but I would like to see, and I think it'd be healthy for Bitcoin to stay in this range. I'd like it to break out of the range, obviously to the upside, but Chupa in the chat says we're getting 4 rate cuts this year. We're not getting 4 rate cuts this year. Like, we're not getting 4 rate cuts this year. We're lucky. We're lucky to get 1 with the data we're seeing with the language the Fed's using. But if the Fed comes out today and says something, slightly more bullish, dovish, that would be great. Maybe they are going to mention the fact that, you do have, that you did have the Fed actually buy some treasuries. Maybe we are going to see some of the news over this and question. If I had to guess, I'd say there's going to be some kind of question today. There should be a question today if the reporters are doing the job over this purchase. Okay, over the Fed buying these treasuries, because the Fed buying these treasuries could mean that quantitative easing is coming. This is a signal for quantitative easing. This is a start to QE potentially. Quantitative easing is going to help us get closer to those rate cuts. Those rate cuts are going to help us to make money cheaper to borrow for the big dogs out there. Woof, woof. And if the money's cheaper to borrow for the big dogs, then our big dog Bitcoin can go woof, woof, and up. And our altcoins, should I woof, woof again? Our altcoins can go up as well. You want rate cuts to get that altcoin pump. That's what you're waiting for. If you're holding altcoins, that's what you should be waiting for, I think, personally. But yeah, there are some people that are still calling for a very risky, very unlikely 300K Bitcoin by June. Recently, we actually had CZ come out and talk about his giant 500K to $1 million prediction in this bull market. What I don't have clarity on is what CZ believes the bull market's going to be in terms of the time frame, right? Because historically, if you guys have been following the content, or not even the content, the just narrative here that's been going on for 4-year cycles, historically, these bull markets last about 1,050 days. It brings us out to about October. Okay. Let me go ahead and do this for you. See this little area down here? The end of this, about a bull market lasts about 1,050 days. That brings us out to October. How high can we go? Well, I don't know, guys. And is this actually going to be the end of the bull market? I don't know. And CZ's coming out with this 500 to 1 million, 500,000 to $1 million Bitcoin prediction. Is that possible by October? I'd call it a very unlikely scenario to get that high that fast, but maybe, you know, CZ and as others are saying, is they're hopping on this kind of no more 4-year cycle train, which, you know, personally, I still have a hard time getting on. But when you do see some of the biggest players in the industry, certainly not me, CZ, the Bitwise CIO has come out, Crypto.com CEO has come out and basically said 4-year cycles are dead, and it's kind of this up only thing, at least for this presidency, which is interesting because, you know, what we've really seen is that this presidency has been slightly bearish for crypto, partially because of the meme coin launch, I think, partially because of politics bleeding into crypto and political shenanigans. Okay. So that's what I'm looking at right now. That's where my eyes are looking. I'm looking to some of the leaders in the industry. I'm looking at the 4-year cycle, and I'm juggling the idea of whether there's a validity to that or not. I really believe Bitcoin dominance can shoot up again, and then eventually I think it still will come back down, and we will have some kind of altcoin season. How we doing in the chat? By the way, shout out to Papa and Scott and Marty and Chupa and Reggie and Filipino wife and I and Chupa and I said Chupa and other Scott, Abit and LMFAO and all you guys in the chat. Shout out to everybody out there. And then all you guys on X who I can't see in the chat. I can't see you in the chat, but I know you're there. Oh, and a shout out to everybody over on Rumble as well. We are streaming these things on Rumble. So we've got a couple of you guys watching over there. Thanks for hopping in, folks. Couple news stories before we actually get this meeting going and kicking off. All right. So, yeah, there are some options trades that are looking at a potential 300K by June. I don't think that's likely. If you look historically, you want to go to 300K, we're going to need to see basically 100% gain this month and then another 50% gain next month. And guys, we haven't had 100% gain on Bitcoin since, in a month at least, since where? There's a 400% gain. I don't see anything else over 100, do you? That's about it. We had a 50% gain in a May, 52% gain in another May. So May could end up being bullish potentially just based on history. But with the Fed, it's tricky. It's tricky. And I say that because you just look at the odds, guys, and the odds are not that great. This May meeting is now, there you go. The next meeting's in 41 days. There you go. You've got the official decision. But looking at June, 70% chance that we're still not going to get a rate cut in June. 30% chance we do. And then into July, 25% chance that we don't get a rate cut by July. For now. But still watching the effects of inflation with tariffs and the Fed. So we got to keep an eye on this stuff. But yeah, I just don't see it going that high that fast either. But we do have a lot of good things happening. Fun story for you guys as we're kind of gearing up for the Fed to speak here. New Hampshire, and we've seen many states proposing this idea, a strategic Bitcoin reserve. The first bill has passed for a U.S. state. This is the first U.S. state to pass a strategic Bitcoin reserve bill. You've got CZ making $1 million Bitcoin prediction. That's nice to see. We've still got the Senate deciding on the stablecoin bill. It was a walkout yesterday. They were walking out of the Senate meeting and did not like this bill, and they're asking for revisions. They want to get some other ideas in there. I still think they're going to figure this thing out, and the people that are opposing this bill are probably going to get some things pulled out of the bill or put into the bill. There's always these negotiations, and they slip in strange things like all of a sudden, in the stablecoin bill, all of a sudden a certain type of muffler on a car might be illegal. They put in the weirdest things. That was the weirdest example, but they put the weirdest things in these bills. It's like a stablecoin bill, but we might be voting on like white bread being illegal or something like that. I don't know, right? That's just these weird negotiations that go on the Hill. But this is in limbo right now. You want this stablecoin bill to get passed so, crypto adoption can continue, and it's getting roadblocked a little bit, okay? There's a little bit of a roadblock being popped up with that. You've also got these stories coming out. 58 crypto wallets made millions on Trump's meme coin. 764,000 have lost money. This is some of the things that is holding up the bill. Everybody likes to rip into this, and this is like the biggest problem in crypto all of a sudden is this meme coin. And Grandpa Rock in the chat, there you go, doesn't like the president, right? There's a lot of that. There's a lot of people that love him. There's a lot of people that hate him. I stay whatever on it. I just am looking at the market. I'm like, what's good for the market? What's bad for the market? I've got an opinion. I just, frankly, who cares what my opinion is on the president? All I care about, and all you should care about, is what is the president's opinion, or what is the president's effect on the crypto market? And just candidly, it's been not that good since he's been in office. Leading up to it, it was like the most bullish thing, right? Everybody thought, crypto, we're gonna make it big and beautiful, and you're gonna love it. Everybody's gonna get rich. That's what it was. And then here we are, and it's not going that well. And he launched a meme coin, and 764,000 people lost money on the meme, and that's the taste in everybody's mouth right now with this. But there is some optimism. You've got industry leaders like this talking about Bitcoin hitting 500K to $1 million this cycle. And this is what I was talking about. I don't know what his definition of this cycle is, right? I don't know what his definition of the cycle is, but there are many people that are calling this some kind of super cycle, some extended bull market. His explanation for this is growing government accumulation and pro-crypto U.S. policy. No doubt. But we do need that stablecoin bill to pass. Just one in the line of many things to come regarding crypto legislation down the pipeline. And we do have growing government accumulation, but we also have some opposition for crypto adoption from countries like Switzerland and Russia and South Korea. And I saw some others recently as well that aren't going to do a national strategic reserve for Bitcoin. But the US did. Now we're not buying new Bitcoin yet. There are some ideas. There are some bills being put out there for potential buying Bitcoin, the government buying Bitcoin. And we also potentially have China getting in. And then I'll tell you this, if China and the US are both buying Bitcoin, even though Switzerland and all these other countries are opposed to this right now, this idea of this Bitcoin reserve, they might hop on board. Okay. You just need the big dogs to do it. And then kind of everybody will follow in suit like sheep. Okay. Everybody follows the big dogs. That's just what happens. So this is the deal, guys. We do have a pause in these rates, and just in a few short minutes, we are going to have the Fed speaking live. Okay. We are going to be having the Fed speaking live. And I am going to, with no interruption, play it for you. We're going to play it live, and we're getting ready for it. All right. So let's pull it up. Let me pull it up because we've got just in a few short minutes, we're kicking it off here. So let's pull the thing up. And let's do a couple questions before we get into it. Before we get on into it. Okay? We are waiting. Here we go. We got it. We got it rocking. We got it rolling. There we go. We're ready for the Fed to speak. Any minute now, we will have the Fed. It is 3 minutes to the top of the half hour. And the Fed is supposed to be speaking. Are you ready? Are you ready? Looking back at the chat right now, we've got 60% of you guys that voted. We see 100K before we see 90K. 40% of you guys are voting for 90K. Lazy Hustler says, some people think cucumbers taste better pickled. Well, that would be pickles, wouldn't it? I do agree. But dill, if you're not having dill pickles, you should not even have pickles at all, in my opinion. And that's a very important topic. And I'm going to do a whole live stream on that at some point. Probably a 4-hour live stream about pickles. Very important. We like pickles in this house. Don't have pickles in the house right now. Actually, my wife's going to go buy some pickles at some point today. It's very important stuff. We don't usually talk about pickles, but I think it's about time, frankly. How's it going, Todd, in the chat? It's actually Scott. We got John. Welcome back, guys. Welcome back. All right. Okay. So I'm gonna keep peeking at Bitcoin while the stream's going on, and I'll give you guys some price updates. Right now, 96.5 is our BTC price. We've got some altcoins showing some fear. Stacks was pumping today. That was pretty cool. XRP was getting a little bounce off 210, slipping back down right now. Again, no rate cuts today. It was a rate pause, and that makes sense. That's something that we've been really anticipating here. Todd says, I made some hot dill pickles. Now, how do you do that? What are you doing? Like jalapenos in a pickle jar with that? Is that what you're doing? Christopher Nelson says, in your opinion, do you think we will end QT and start QE? Christopher, the Fed bought $35 billion worth of treasuries. It could be happening right now, my friend. And that's the biggest thing that I'm going to be an eager beaver to hear today, okay? If the Fed did do what is being put all over X today, and they get a question about it, and they start talking about quantitative easing, it could be good. And here we go. The Fed Chair Jerome Powell is taking the stage. Let's eliminate the tunage. Beautiful. And let's kick it into high gear. And let's put on the audio. We're waiting on the Fed. Here we go. Here we go, people. Fed Chair Powell going to take the stage. Let me know if you got the audio. Always got to make sure of that. Look at him. Look at him. Confident, hunched over, gray hairs. Beautiful. Pull out your paper. Can you hear him? Let me know.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leitsman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
John L.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. You know, we haven't faced that question in a very long time, so again, difficult judgment to make, and not one that we face today. And we may never face it, but you know, we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
You know, it's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is you know, we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, just, you know, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks, and that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen. But they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned, and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things that, but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in the actual economic data yet. And by the way, consumers keep spending, credit card spending. It's, it's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a we're down a couple of trillion, but I get clearer or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not in your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about the a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there would be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
Yeah, I don't know where 4 cuts came from.
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. We don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other. And if so, you concentrate on that one. And frankly, that was the case well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. If I think what our framework document says, it says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to, speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path. And it's on Congress to figure out how to get us back on a sustainable path. And, it's not up to us to give them advice.
Or do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, we wanted to address that forthrightly. We wanted to show that we were there we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
Yeah, I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Claire.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly?
I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is, this is their mandate, not ours. And I know as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decisions. So the volume of the imports, imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories, government, or inventories, government. Anyway, it's a cleaner read on private. demand. But that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right, though. We had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you were monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else. And, right now we see inflation, kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night. And this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy, when it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
Wow. Oh, I gotta stop this music. Okay. All right. Hopefully we didn't get a copyright strike on that music at the end there. All right, guys. Wow. Wow. Thanks for tuning into the Crypto Report. Let's break it down a little bit. It doesn't sound good for rate cuts. That's my in-depth analysis for you. That was interesting. Marty, Marty's take is funny in the chat. If you've been watching the chat at all, Powell doesn't even care anymore. He is just willing to challenge everybody and look at them as if they're the stupidest person on earth every chance he gets. Every other question, he'd be like, I'm not answering that trash. That's basically what he was doing. A lot of interesting questions, one of the big ones being, he's mentioned about having 2 rate cuts this year. And, is that what you still see? Or what do you think it's going to be? And he said, well, we do it every other meeting, which is like, why not do it this meeting? It's an interesting rule. He's got a rule. It's a made up rule where he's like, we do it every other meeting. We're not going to do it this meeting. Maybe he shouldn't do it at all, to be honest with you, because look what happened. He said, hey, we're probably going to get 2 rate cuts. And now we don't even know if we're going to get 2 rate cuts. Now the data's changed. Tariffs have changed. There was one very positive thing that came out of this meeting, in my opinion, when he was asked specifically about tariffs and their impact. He did say that they haven't really had an effect on anything yet. It hasn't changed the data yet, though it has in people's minds. It has changed the ideas that people have, right? I mean, people are fearful that it's going to be bad, and it makes sense that it could be bad for inflation. These tariffs being bad for inflation. That makes sense, right? But he also did mention, and Chair Powell did mention, that there are major conversations going on with some of our key trading partners. And if that is a positive outcome, well, then, maybe things aren't so bad after all. So it's just too early to say anything. We got to look at the data. We have to look at the data. I thought it was hilarious. Probably one of the highlights of the meeting for me was when he said, I don't go to the presidents. They come to me. King of the castle, la la la, king of the castle. Chair Powell. Just a bold, sassy Powell. How about that, guys? Let's look at the Bitcoin chart. Let's look at that Bitcoin chart real quick and see what is what. we didn't have as much volatility during this meeting that, I personally would have expected to see, honestly. Here we are in 96.3. One of the least volatile meetings, honestly. Very surprising to me. Very surprising how little volatility there was. We sold off out of the gates leading into the meeting, and we kind of just kept going down. At one point, we spiked back up to like almost 97, but we're kind of coming back down. Overall, was he hawkish or dovish? I would say that he was hawkish in disguise. With just a dash of optimism when he mentioned the fact that, hey, we are in some key negotiations with our strategic partners, our strategic trading partners, which was pretty darn cool. Philip in the chat says, can you compare ECB, the European Central Bank rate cut data, to U.S. data? Just wondering why ECB lowers rates and U.S. does not. Well, Canada lowered the rates, I believe. ECB did. Well, right now in the U.S., we've just got worse inflation. And what we've also got going on is some uncertainty around tariffs, which are less so in Europe. Certainly the U.S. tariffs are going to impact Europe, but it is our maneuver. It is our decision to do. It is the president's decision for these tariffs. These tariffs could impact Americans. We are overseas. I think that that's kind of got a lot to do with it personally. I could try to make a video on that as well, but that's just kind of my impromptu take on it for you there. But yeah, pretty unbelievable meeting, kind of a nothing burger for the markets. But am I the only one that thinks that like we're not going to get a rate cut now? Am I the only one feeling that? Let me put out a poll on the YouTube and say, how many rate cuts later this year? I'm going to go 0. I will go 1, and we'll go 2, and we'll go 3 for all you crazy people out there that think 3 is possible. I don't think 3 is possible. Somebody out there said 4 rate cuts. What? Why would there be 4 rate cuts? I doubt it. I don't know. Unless all of a sudden these trade negotiations go well with the president, which could happen. The art of the deal, maybe. Maybe. We'll see. We'll see. Odds. Okay, so we've got votes coming in. How many rate cuts later this year? 22% of you guys say 0. 22% of you guys say 1. 44% of you guys say 2, and then we got 10% saying 3. Very interesting. A lot of people still staying optimistic for 2. I'm curious, guys. I'm very, very curious. Daryl says we won't get rate cuts until tariffs fears subside or the Fed and confidently say the tariffs won't affect inflation. He's not going to say that. He's not going to say that. We need the tariff thing to go away. I mean, he's already said the tariffs will affect inflation. He will continue to say they will. They could. Because they could. They really could. They really could. How's it going, Khan in the chat? KON in the chat. How's it going? How's it going? Scott says China's printing money now. Yeah, I was surprised that we didn't get a question about that Treasury buy. That was pretty shocking to me personally. So that's it, guys. There's your FOMC. I think that it was probably leaning bearish, to be honest with you. But let's see what shakes out. The good news is Bitcoin is the hedge against inflation. Inflation is tricky. So Bitcoin's the hedge. I vote Bitcoin. Thanks for tuning in. I'm Crypto Kip. This is a Crypto Report. Smash the like button. Subscribe to the channel. Thank you for choosing the Crypto Report for this FOMC live stream. I appreciate each and every single one of you guys. Smash the like button. Subscribe to the channel for more. And until next time, folks, deuces mooses. I'll see you in the next one.